seemingly overnight, the internet is buzzing about this new unfair mortgage tax on borrowers with higher credit scores. Some have even gone so far as to suggest that someone should intentionally lower their credit score in order to get a better deal. This is absolutely not true. We'll talk about this here in just a second. But we're starting to see some very scary headlines out there stating that borrowers with a 620 FICO score actually get a 1.75% discount fee, while the borrower with a 740 FICO score actually is going to pay an extra 1% in fees. While I will admit this sounds terrifying, this has everything to do with what we call loan level pricing adjustments, or LLPAs. And these are imposed by Fannie Mae and Freddie Mac, which are the two entities that guarantee the vast majority of new mortgages. Loan level pricing adjustments have been in place for several years. It's basically a way for the lender to associate a risk profile with a specific borrower and a specific property. So it takes into consideration things like the credit score of the borrower and the equity position of the home. So how much is owed versus how much the property is worth. So if you have excellent credit and you have a really large equity position, generally you're going to get access to the best rates and the best pricing. These new changes were actually announced back in January, but they didn't get implemented until May 1st. That's the delivery date to Fannie Mae and Freddie Mac. So even though we're starting to see all of these headlines in the news talking about this, many lenders have already implemented these LLPAs months ago because they were pricing them in based on when those loans would actually be delivered. Because what happens is, let's say a lender hypothetically funded a loan last month and they didn't implement these pricing adjustments, and then it didn't get delivered to Fannie Mae or Freddie Mac until maybe later this month here in May, then that lender would be on the hook to pay that pricing adjustment, which ultimately comes out of their margin. So many lenders out there have already implemented these pricing structures, but it's still important to be aware of exactly what is taking place. Before we get into the exact details here, if I could ask just one small favor. At the time of this recording, we're sitting at 970 subscribers. I would really love to see that number jump up to over 1,000. So if you like all things real estate and you want to stay current on all of the housing trends that are taking place in the market in hopes that it will help you buy right and borrow smart, please consider hitting that subscribe button. I would be so grateful. Now let's go ahead and get back to the details. The main question that are on most people's minds, or the elephant in the room, is that everybody wants to know whether or not the borrower with a lower credit score is getting a better deal than someone who has a higher credit score. Now that is actually not true. However, the LLPAs are changing in a manner that improves the cost for the lower credit score borrower, and it increases the cost for the borrower who has higher credit. So what it means in reality is the pricing differential between the two borrowers is starting to shrink. Now, I'm not here to state whether or not I think that's good or bad. I'll let you make that decision on your own, but I do want to point out these pricing adjustments. And in order to do that, I'm going to go ahead and pull up a couple charts so you can see exactly how it's impacting the pricing at different loan to value thresholds and different credit scores. All right, so the first chart up on the screen that we want to share is the no cash out refinance. This is the change in cost. Everything in red is the pricing adjustments for the worst. Anything in green is actually pricing improvements. On the left-hand side here, you have the FICO score column. This will show you anything that is sub 639 FICO and anything that is over 780, and then you have the loan to value thresholds here as well. So how much you owe versus how much the property is worth. The further left you go on the chart means that you have a greater equity position, whereas the further right means that you have a smaller equity position. For instance, if you have a loan to value at 95%, means that you have 5% equity in the property. And of course, this is just an estimation until you actually have an appraisal done. So let's take a look at the largest pricing adjustments that we're seeing here. Right out of the gate, that stands out to me is that you have a 1.25% adjustment to the pricing if you have a 720 to 739 FICO score and your equity position is between 80 and 85% loan to value. So that's the largest adjustment that I am actually seeing on the screen. And you can see that as FICO scores go down, this borrower or potential borrower between 660 and 679 is only getting a pricing adjustment of 0.25%. So there is a major gap. That's a 1% difference in the pricing, which will have an indirect impact on the interest rate. Doesn't mean that this borrower is paying 1.25% higher. It just means that their cost structure is going up by 1.25%. This borrower will still get a better interest rate than the borrower who has a credit score that is sub 680. There's a couple areas where the pricing actually improved. So in areas where we have less equity in the property, we saw some pretty good pricing improvements. The one that stands out the most to me is this one here down in the bottom right-hand corner. If a borrower has less than a 639 FICO score and they have a loan to value that is greater than 95%, we're seeing a pricing improvement of 1%. Which means that that mortgage rate is going to get a little bit better for that borrower here. All right, let's go ahead and switch gears slightly here. We're gonna look at how these pricing adjustments are impacting purchases. So if you're a potential home buyer in this market, this is what you're gonna wanna actually pay attention to. We'll point your attention to what is in bright red here. These are gonna be the largest pricing adjustments for the worst that we're seeing. It's with borrowers who have between a 720 and 759 FICO. If they are sitting between 80 and 85% loan to value, they're seeing a 3/4 point adjustment to the pricing. That's gonna be the largest on this pricing adjustment sheet here. One thing that I'll point out is that you'll wanna get creative as a borrower, or if you're a loan officer, when you're pricing out borrowers, you're gonna wanna take a look at different loan to value thresholds at different credit scores, because you could potentially improve the pricing for a borrower if maybe they put a little bit less money down, or maybe they have the ability to put a little bit more money down, and then their pricing adjustment will be impacted a little bit less than it would have otherwise been. Some of the green here, this is where we've seen all the pricing improvements. And I think this is what has a lot of people really upset. I'm not really here trying to debate any of this, but in many people's minds is that the borrowers with the higher credit scores are now subsidizing the borrowers with the lower credit scores. And a lot of people work very hard to ensure that their credit scores are excellent because they want access to the best rates and the best pricing that's out there. So I could see why someone would get maybe a little bit frustrated hearing this information. A couple areas that did not change, and I want to point that out. If you are purchasing a home with less than 15% down, we saw no price change here at all. And then if we are putting more than 20% down, we actually saw pricing improvements as well if you're in the category with a 780 FICO score or higher. So again, if you have excellent credit, you're still going to get a better rate than somebody that, let's say, has less than perfect credit. All right, so what I just showed you is the actual changes that were implemented. Now let's take a look at the purchases and the actual loan level pricing adjustments for each borrower. So you can see here, this different color chart is going to show you exactly how borrowers at different credit scores are impacted. And this is the outright chart. Somebody with a 640 to 659 credit score is, and let's say their loan to value is between 80 and 85%, they're going to have a 2.5% adjustment to their rate and pricing, whereas somebody with a 720 FICO score is going to have 1.25% pricing adjustment. Previously, this would have been 0.75% lower, so the rate would have been better. So as I mentioned, with a borrower that has a higher credit score, you will get a better interest rate, but the gap between the two are shrinking. If you have excellent credit and you're putting more than 20% down, you're not getting any pricing adjustment here. And for those borrowers who are putting less than, let's say, 10% down, the pricing adjustment there is minimal. So is this going to be a big change? Yes, absolutely. I think it will be. It's affecting rates and pricing across the board. And why are the government-sponsored entities, Fannie Mae and Freddie Mac, actually implementing this? And the answer for them is relatively simple. They are on a mission to promote affordable home ownership, and this is one of the ways that they can actually do it. So what do you think about this? What do you think the consequences will be? I would love to hear from you. Leave it in comments below. One thing that I am concerned about is this is tweaking the demand side of the equation. Essentially, it's going to have an uptick in demand because the borrower with the lower credit score that was maybe priced out before, they're going to get better rates in pricing now. Maybe it allows them to qualify, which is going to bring more demand back here when we have still a very low level of supply. It's not adjusting the underlying issue of housing stock or bringing more supply online, which I think is the biggest issue that we are facing in the housing market right now. So anyway, I hope you enjoyed this content. If you found value from it, please consider hitting that subscribe button. We're trying to get to 1,000 subs. Please help me out. I would be so grateful, and please consider liking and sharing the video, and we'll see you next time. Take care.